Every single year, a multi-billion-dollar retail titan sells close to 100 million rotisserie chickens at a fixed, unyielding price of just $4.99. Despite massive inflation, rising supply chain logistics, and skyrocketing labor overhead, this price tag has not changed in decades. In fact, the company willingly bleeds tens of millions of dollars in raw cash every single year just to keep those roasted chickens affordable and hot at the very back of their warehouse floors. To the uninitiated business owner, this looks like complete corporate madness, a financial suicide pact designed to destroy shareholder value. But behind this seemingly irrational pricing strategy lies one of the most brilliant high-yield and mathematically precise monetization funnels in the history of global commerce. The shocking reality is that this retail giant does not care about making a profit from the items it sells on its shelves. From television sets and car tires to bulk groceries and diamond rings, they intentionally strip away their own retail margins, operating their entire physical inventory practically at a break-even point. How can a business that moves hundreds of billions of dollars of physical goods every single year generate massive, record-breaking net profits while refusing to make money on its actual merchandise? Welcome to BizBlueprint. Today, we are going to reverse engineer the financial architecture of Costco Wholesale. We will dissect its highly calculated upfront infrastructure investments, explore the brutal efficiency of its daily operational cost-cutting, and uncover the ultimate retention blueprint that transforms cheap food into a subscription charging machine that legally prints corporate wealth. To truly master the mechanics of Costco's business model, an entrepreneur must first execute a complete mental shift. Traditional retail is a transactional game. A merchant buys an item for $5, marks it up to $10, and attempts to maximize the volume of transactions, while fighting brutal price wars against competitors. Success is dictated by the net margin extracted from each individual sale. Costco fundamentally rejected this entire framework. They realized that chasing transactional retail margins creates a permanent friction point with the consumer, forcing the business to constantly search for cheap traffic. Instead, Costco transformed retail into a subscription ecosystem. They are not in the business of selling physical goods. They are in the business of selling access. Today, Costco is a global behemoth, generating over $240 billion in annual revenue, commanding an ironclad grip over 85 million paid member households across North America, Europe, and Asia. But the true genius of their financial blueprint is how they utilize a massive physical footprint as a psychological loss leader. By offering the lowest possible prices on high-quality bulk merchandise, they construct an irresistible value proposition that forces consumers to willingly pay an annual recurring fee just for the right to walk through the door. For a modern business operator, this is the ultimate manifestation of a front-end customer acquisition funnel, feeding a high-margin, back-end recurring revenue engine. To see how this capital-intensive funnel is designed from the ground up, we must examine the first pillar of its execution: capital expenditure, or CapEx. In mainstream retail marketing, capital expenditure is heavily front-loaded into consumer-facing vanity metrics. Legacy department stores and supermarkets deploy billions of dollars of CapEx to fund digital ad spending, execute complex television campaigns, and build highly styled, aesthetically pleasing interior environments designed to look luxurious. Costco applies a philosophy of radical capital efficiency. They eliminate traditional marketing expenditure entirely. Costco has no official advertising budget, runs no promotional commercial spots, and employs no external ad agencies. Instead, their capital expenditure is hyper-focused on two internal structural asset classes: low-cost real estate industrial shells and deep, backward supply chain integration. Let us look first at their real estate development model. Costco's CapEx algorithm dictates that physical locations must be constructed as minimalist, bare-bones warehouses rather than traditional retail outlets. These structures are typically located in secondary industrial zones, outside of high-rent city centers, significantly reducing land acquisition costs. The buildings are massive, steel-framed concrete slabs averaging 146,000 square feet. Inside, there are no expensive drop ceilings, no decorative light fixtures, and no automated display racks. The lighting is industrial, the floors are polished concrete, and the inventory is stacked 40 feet high on heavy-duty industrial pallet racks. By refusing to waste capital on cosmetic retail architecture, Costco ensures that their cost per square foot of construction is a fraction of the industry average. For an entrepreneur, the actionable lesson here is clear. Prioritize asset utility over aesthetic vanity. Costco forces the physical infrastructure to serve a purely functional purpose, storing and moving massive volumes of goods at maximum speed. However, when Costco does decide to deploy massive capital, they do it to achieve complete control over their supply chain costs. A prime example of this strategic CapEx deployment is their investment in internal production facilities. When rising poultry costs threatened the $4.99 price point of their rotisserie chicken, Costco did not raise the retail price, nor did they accept a lower margin from third-party suppliers. Instead, they deployed over $400 million of capital expenditure to build their own industrial poultry processing plant in Fremont, Nebraska. By vertically integrating their supply chain, owning the hatchery, the feed mill, and the processing infrastructure, Costco gained absolute control over the input costs of their most critical customer acquisition asset. They spent $400 million on a farming factory not to make money on chicken sales, but to permanently lock in the low-cost fuel that feeds their customer conversion engine. This is high-level asset optimization, using CapEx to insulate your primary customer acquisition hook from macroeconomic volatility. The Deep Dive, Part 2, Pillar 2, Operational Expenditure, OpEx, 050830. Now that the capital architecture is locked into the ground, the operator enters the daily battlefield of cost management. In the retail sector, operational expenditure, or OpEx, is the silent killer of growth. Traditional grocery chains spend immense daily resources managing what is known as SKU proliferation. A standard supermarket stocks anywhere from 30,000 to 50,000 distinct items, or stock-keeping units. This vast variety creates a logistical nightmare. High tracking overhead, massive inventory management payroll, and a devastating waste metric known as retail spoilage. If a product sits on a shelf for 3 months without selling, it ties up working capital and eventually expires, turning directly into a dead loss. Costco executes a brutal, counterintuitive pruning of their daily operational expenses by practicing extreme SKU limitation. While a competitor like Walmart or Kroger stocks tens of thousands of items, a massive Costco warehouse stocks a maximum of just 4,000 SKUs. For an entrepreneur, this is a masterclass in operational leverage. By limiting their inventory to just 4,000 items, Costco achieves two profound economic advantages. First, they drastically simplify their internal store logistics. Employees spend zero time sorting through thousands of obscure, slow-moving brands. Inventory moves in massive uniform volumes, straight from the delivery truck to the sales floor. Second, this extreme concentration gives Costco absolute monopsony power, meaning they act as the dominant buyer in the market. Instead of buying 10 different brands of ketchup, Costco buys exactly one. Either the market leader like Heinz, or their proprietary private label, Kirkland Signature. When Costco approaches a supplier to purchase just one single SKU, they are not ordering boxes. They are buying out the factory's entire annual production capacity. This massive scale allows Costco to dictate wholesale prices, driving their input costs far below any competitor on Earth. Furthermore, Costco slashes its daily floor OpEx by treating the warehouse itself as a logistics cross-dock. In a standard retail store, employees spend hours opening cardboard boxes, neatly arranging individual items on delicate shelves, and rotating stock by hand. At Costco, individual shelving is completely banned. Garments, canned goods, and electronics are delivered directly on heavy wooden shipping pallets. Forklifts drive these pallets straight from the delivery bay directly onto the concrete floor. The consumer picks the item directly off the wholesale pallet. This simple operational shift cuts the store's retail labor expenses by over 50% compared to traditional supermarkets. By stripping out decorative marketing, banning manual shelving, and limiting product choices, Costco drives its overall operational overhead down to roughly 10% of its total revenue, compared to an industry average of over 22%. They run a multi-billion-dollar operation on absolute bare-bones efficiency, proving to any business operator that operational simplicity is the ultimate margin protector. With operational expenses crushed to the absolute bare minimum, we arrive at the core geometry of Costco's monetization matrix. To understand their revenue streams, an entrepreneur must separate the business into two distinct engines: the low-margin product volume funnel and the high-margin subscription cash engine. Let us look first at the product funnel. Costco operates on a strict, unbreakable corporate pricing law. No brand name item can be marked up by more than 14%, and no private label Kirkland Signature item can be marked up by more than 15%. To put this in perspective, traditional supermarkets routinely mark up products by 30 to 40%, and clothing retailers regularly apply markups of over 100%. When Costco negotiates a massive discount from a supplier due to its monopsony buying power, they do not pocket the savings to expand their retail margins. Instead, they pass 100% of that discount directly to the consumer. This product stream generates hundreds of billions of dollars in top-line revenue. But after accounting for the raw cost of goods sold and basic storefront overhead, this massive product volume operates practically at a financial break-even point. So where does the record-breaking net profit actually come from? It comes entirely from the second engine, annual membership fees. Costco operates a multi-tiered entry ticket funnel. To shop at the warehouse, a household must pay a recurring annual subscription fee, ranging from $60 for a basic Gold Star membership to $120 for an executive membership, which offers a 2% cashback incentive. Because this subscription revenue carries zero inventory costs, zero shipping logistics, and zero retail spoilage, it operates on a near 100% gross margin profile. Every single dollar collected from a membership card flows almost entirely straight down to Costco's net profit line. In their annual financial statements, membership fees routinely account for over 80% of Costco's total net operating income. This structure creates a brilliant psychological alignment between the business and the consumer, known as the retention loop. When a customer pays $60 or $120 upfront just for the right to shop, a powerful cognitive bias takes over. The sunk cost fallacy. The consumer feels a psychological urge to justify that upfront expense. Every time they need to buy groceries, electronics, or gas, their brain calculates that they must shop at Costco to get their money's worth from the membership card. This drives an unprecedented customer retention metric. Year after year, Costco maintains a staggering global membership renewal rate of over 90%. They do not make money by selling you a flat-screen television or a box of steaks. They use the low-cost television and the $4.99 chicken as a psychological hook to keep you locked into an annual $60 cash loop that automatically renews forever. We have reverse-engineered the capital infrastructure, the operational cost-cutting algorithms, and the dual-engine monetization funnel. Now, we arrive at the final financial validation of the Costco Wholesale model, the margin architecture, and the high-leverage math of its break-even point. In classic accounting, corporate viability is evaluated by looking at a company's net profit margin. For traditional retail conglomerates, maintaining a net profit margin of 3 to 4% is considered a solid operational victory. Costco operates on a net profit margin that strictly hovers between 1.5 and 2%. To an outside investor who does not understand the underlying architecture, this looks incredibly fragile, a razor-thin cushion that could be wiped out by a minor macroeconomic downturn. But for an active business operator, this thin margin is the ultimate indicator of capital efficiency and competitive defense. Because Costco's operating income is secured by recurring membership dues rather than volatile product sales, their net margin is exceptionally stable and insulated from consumer spending slowdowns. To understand their break-even dynamics, an entrepreneur must look at a metric called inventory turnover velocity. A traditional supermarket turns over its entire inventory roughly 8 to 9 times a year, meaning products sit on shelves for an average of 45 days before converting into cash. Costco turns over its inventory a staggering 12 to 14 times a year, clearing its entire warehouse stock every 30 days. This creates an extraordinary cash flow phenomenon known as a negative working capital cycle, or the cash float. Because Costco sells its inventory to members within 30 days, but negotiates extended 60-day payment terms with its wholesale suppliers, Costco receives cash from consumers a full 30 days before they legally have to pay the manufacturer for the goods. Costco is essentially operating a multi-billion-dollar unregulated bank. They use their suppliers' capital as interest-free cash float to fund the construction of new warehouses and expand their infrastructure without taking on expensive bank debt. The product break-even point is reached almost instantly through sheer volume velocity, turning the entire operation into a low-risk, self-funding wealth engine. The primary structural risk hanging over Costco's blueprint today is not product competition, but demographic subscription fatigue. As younger generations shift toward digital-only, direct-to-home delivery services like Amazon Prime and Instacart, the physical requirement of driving a vehicle to a suburban industrial warehouse to buy bulk goods faces a generational headwind. Costco's traditional moat relies entirely on a physical consumer routine. If fuel prices soar permanently, or if urbanization reduces the desire for bulk home storage, Costco will be forced to deploy heavy new capital to rapidly transition its bare-bones infrastructure into a high-cost digital fulfillment network, directly threatening the ultra-low OpEx profile that keeps their membership value proposition alive. The economic blueprint of Costco Wholesale exposes the ultimate triumph of recurring revenue models over traditional transactional commerce. Costco proved to the global business community that the most effective way to extract massive, long-term wealth from a market is not by maximizing the margin on your product, but by completely eliminating product friction to build an absolute monopoly on customer access. They stripped away the expensive vanity of retail advertising and cosmetics. turning a massive physical warehouse into a high-throughput data and psychology funnel. They built a retail store on the outside, but underneath the concrete floors and steel beams, it is a highly sophisticated subscription engine that monetizes human cognitive biases and supply chain scale with absolute mathematical precision. How much money do you spend annually on subscription access fees? And do you feel the psychological urge to shop more frequently at a business once you have paid an upfront membership fee? Do you believe Costco's bulk warehouse model can successfully maintain its 90% retention rate against the continuous rise of instant digital delivery platforms? Or will subscription fatigue eventually break this retail engine? Let us know your thoughts in the comment section below. Do not forget to hit like, subscribe, and turn on the notification bell so you never miss the next operational breakdown from BizBlueprint. We remain hyper-focused on dissecting the actual mechanics and structural designs of the world's most complex business machines. Thank you for watching, and see you next time.